love the channel and find it useful in becoming a happy retiree. Subscribe today. We're all trying to invest for retirement so that we don't have to work anymore, or we have financial independence. Sometimes it takes a tremendous amount of patience. I would argue that today that is certainly what we are experiencing. But I go back and I'm doing an interview with Barron's this week, and they wanted to know about the early part of my career. So I sat down and I thought about this for a little bit, and I just went back and I looked at the market. So I started in the investment business in the 1990s, in the latter part of the 1990s. And if you're an investor and you remember around 1981, things started to really look up for U.S. equity markets. And we had this just tremendous bull market in the 1980s and the 1990s here in America. And if you think about all the technological change that was really coming to fruition in the 80s, and then of course in the 1990s, productivity was tremendous. The stock market was just on fire year after year after year. So long, we're talking about almost 20 full years of these massive gains year after year after year, that investors got lulled to sleep. And we ended up creating what we all know now, of course, was that bubble that popped right after 1999. So I think of 1999 as the end of that massive bull market run. Of course, it was March of 2000 that the NASDAQ hit over 5,000, then crashed almost 80%. Well, the Dow and the S&P 500 did something similar, not quite as bad as the NASDAQ, but we're talking about almost 50% pullbacks. And then, of course, we recovered from that to some extent. Then we had the great financial crisis in 2007, 2008, and it happened again in even more dramatic fashion. But if you go back and you look at when I started, so I was a market investment advisor intern back in 1997 and 1998. I went full time. And I went back, you look at the summer of 1998. So look at June, July of 1998. This is what's fascinating to me. 5 years after I started in the business in the late 90s, 5 years later, well, let me give you the initial level. When I started, the Dow was at 9,000. 9,000. And again, I went into an environment as I was starting, everyone around me was rah, rah, rah. Markets only go straight up, and they do it all the time. 5 years later into the business for me, the Dow was lower. 9,000, then now 5 years later, 8,500. That's a half a decade. Markets actually, from an odometer reading, lower. We'll get to the income in a minute, but let's go through the headline numbers here. Then we go another 5 years, so the end of my 10th year in the stock market as a full-time investment professional. By the end of the 10th year, the Dow was still lower, 8,600, than when I started. An entire decade, started at 9,000, 10 years later, 8,600. Talk about frustration. It was not until the 11th year as a full-time investor for me when markets started to break through and actually make new highs, make sustainable highs that we saw in the around 2009, mid 2009. It took all the way until July of 2009, 11 years later, to get back to 9,000. Talk about what do you think that did to me as an investor, or what did it do to all of us during that period of time? First of all, I never lost faith in the power of the U.S. economy. And I never lost faith and I never lost belief that businesses in America and earnings in America, I never lost faith that earnings wouldn't continue to grow. It did test my patience. It was frustrating. I'm a human. And it absolutely tested my patience. But eventually we came out of that. Think about how fascinating this exercise is. Summer of 1998 to July or summer of 2009. It's exactly 11 years. And we are staying at the exact same number, meaning that we start when the Dow was at 9,000 and we finish the exercise when the Dow was at 9,000. The difference, 11 years. So, of course, mathematically, your capital appreciation, or your rate of return, is perfectly zero over that period of time. Bought a stock at 90, 10 years, 11 years later, it's at 90. Well, it didn't go anywhere. Didn't lose, didn't gain, just perfectly zero. But we're forgetting the dividend. So what was your total rate of return during that period of time? Well, if you take your dividends and you reinvest your dividends over that period of time, you actually made 31% over that 11-year period. Now, again, it's about as bad as you can find a long period of time in the U.S. stock market, and that's what makes this so important to understand. You still averaged 2.5% per annum in this exercise. The timing couldn't be worse. So the timing in my career couldn't have been more frustrating. Let's get started after everyone's rah-rah about the stock market for 20 years. And then we go for over a decade, we're headed nowhere. It really hit me over that period of time. One of the very few things that kept me sane and kept investors, their portfolios actually working for them, was the income. And this Dow example, for the 30 companies in the Dow, this is a perfect example of why income works. The dividend alone, in reinvesting, instead of a 0% return, you had a 31% rate of return at 2.5% a year. So that's the very worst decade that you can, or one of the very worst periods of time you can find. How about bonds, though? Remember, balanced portfolios are going to include some fixed income or bonds. The aggregate bond index was up 87% during that period of time, average 5.85%. The investment grade bond index did 68% or 5% on average per year. The power, my friends, of income. So as we wrap up today, we talked about this really just tremendous example that I've never shared with you before, and this kind of came up as I'm being interviewed about the kind of the earlier days of my career. But it's fascinating to me to see a Dow of 9,000 in the summer of '98, and 11 years later, the Dow of 9,000 in the summer of '09. 11 straight years for lots of activity, obviously. So up and down and a complete roller coaster. But imagine you effectively drew a straight line from point A to point B where you went nowhere. You didn't go higher, you didn't go lower. So you have a 0% capital appreciation. Take the dividends in that terrible period of time during markets for the Dow, and you had a 31% rate of return, not a 0 rate of return. 0 capital appreciation, but 31% when it came to dividends. It equated to 2.5% rate of return. Terrible, nothing to get excited about, but fascinating in the respect that on the surface, you look at a period of time where you thought you might not make money. That's not true. Dividends matter. What did that teach me during my early part of my career? The importance of income. Income matters. It is sometimes the only thing that you're going to really get if you look back, particularly if you look back from '09 and you're a complete stock market investor. You look back over the 11 years in the summer of '09, you said, wow, at least I have my dividends. In a more normal market environment, your dividends add to your total return, which is, of course, what we're all looking for. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.